Good afternoon, everyone. Welcome to the panel and from T+1 to continuous markets, the evolution of market structure. My name is Raisa Shimaj. Patrick is doing God's work, hyping everyone up and pronounce my name perfectly, which doesn't happen too often. I'm here today representing ShareGain. We are a capital markets fintech that enables retail-facing financial institutions to offer fully paid lending to their clients quickly, efficiently, and at scale. I'm honored to be sitting here next to my esteemed colleagues from Drive Wealth, FIS, Fidelity, and Northern Trust. And before we get into it, I'll let my guests quickly introduce themselves.
Cool, thanks very much, Risa. I'm Harry Temkin. I'm the Chief Digital Officer of Drive Wealth, and I'm basically responsible for the digital innovation of the company. And what that means is I'm always thinking about how we take analog, traditional brokerage functionality and modernize it, make it available through a digital API. If you don't know who Drive Wealth is, basically we are the first cloud-based API-delivered brokerage as a service platform. You might say, what is brokerage as a service? Well, effectively it allows our clients, our partners, to natively and easily embed investing directly into their web or mobile experience with literally zero traditional brokerage infrastructure. That's the key. The company was founded in 2012 with the mission to democratize investing. We were the first to build real-time fractional trading. Today we support about 100 partners, ranging from digital wallets, neobanks, e-commerce platforms, broker-dealers and RIAs making the move to digital. 100 of those around the world, and we support tens of millions of end users.
John Avery, FIS. Thanks everybody for supporting our panel here. I have actually been in the capital markets industry for about 27 years or so, and most of that time has actually been with FIS, and we're one of the largest providers of fintech in the markets today. We actually help many of the clients with their needs on both the sell side and the buy side. So we have a tremendous amount of experiences to share from our technology backgrounds in this space, and particularly the evolution and the history of settlement and settlement durations over the many years here as we look back. And we're helping many of our clients sort of look forward as well. So I am here representing a small team of thought leaders who actually help engage with our clients during the sales process. And we get to experience a lot of our clients' demands when they really first articulate, for example, what a broker might be thinking about, where they want to go over the next 5 years. Myself and my team get to experience and hear that firsthand. So really excited to share some of that with you all today.
Oh, thank you. Hi, I'm George Nario. I'm with a little company known as Fidelity Investment. I used to run capital markets. I was CEO of capital markets for quite a number of years, ran trading, and I said I had enough in 2017. And I was going to retire, but in reality I was going to go back to my roots because I was originally a founder here in this area, in the New York Stock Exchange. And then there made me an offer I couldn't refuse, which was to run FCAT. And so with FCAT, it's sort of like I'm a startup inside of a financial giant. And so we have a whole bunch of different things. We have incubators on blockchain, on digital crypto, but we also on real-time trading, on AI, on you name it, and we have it. And we often reach out to a number of startups and try to find relationships. If you want to, we also have quantum, so I can show you some quantum. We think we're the only ones that have 2 networks quantum that are actually working. So anyway, whether it's on the technology geeky side, and I'm originally a geek myself, or whether it's about the business issues and about the trading and about the trust and about T0 and all that other stuff, FCAT is a great way to, if you want to connect with Fidelity, FCAT is a great way, right? Because we're looking to partner with people of different backgrounds, different companies, from the very big banks to the very small ones, and with just figure out how to do things better in today's environment. So the cloud and all the stuff that we talked about here is where I live.
Thanks. I'm Arijit Das. I work for Northern Trust, which is a Chicago-based asset servicing, wealth management, asset management company. We have roughly about 15 trillion assets under custody. My team focuses on emerging technologies in the digital asset space. So we look at anything that is going to significantly change how assets are exchanged, how the life cycle of an asset is going to be made more efficient. And we try and work with the rest of the traditional systems to make sure we're coming up with solutions and eventually products which works seamlessly across both worlds. So I'm head of development of that piece, and my team really builds the POVs and the MVPs and even some of the production systems that we have, mostly using DLTs, distributed ledgers, but also other emerging technologies. We haven't quite done quantum yet, but it's certainly intriguing. Thank you.
Thank you, gentlemen. So just to set the scene a little bit, in May of this year, the US and a couple of other countries moved to a T+1 settlement cycle. By many metrics, this move was a success. We're today talking about evolution, right? So before we talk about where we're going, John, you described yourself as a little bit of a historian on our last call. So do you mind just setting the scene and telling everyone how we got to where we are today?
Indeed. I'll set the scene real quick. And this is an interactive session, so I am going to ask you all to raise your hand at some point here for a little test. We just quickly, definitionally, for those that aren't aware what T means, it means today, right? If you're making a trade, well, then, and if you're making that trade today, that's T. T+1 means that something happens tomorrow. T+2, 3, 4, et cetera, just pushes the time out into the future a bit. I am a little bit of I've actually grown up around settlement cycles. I did a little bit of homework for this panel, and I realized that when I went back into the Wikipedia and looked at the history of settlement dates, I was actually born in 1975 when we went to T+5, right? There was some acts, there was some legislative activity I was not aware of in 1975, but sure enough, there it was, 1975. That means 1993, when I graduated high school, we went to T+3, all right? So you could sort of start to see the journey here. We were, T+2, 2017, and then 2024, T+1, right? Ideally, if we just waited a year for T+1, that, if there was any delays, it was a great rollout. But if there were any delays, I would have got to my 50th year here on T+1. So the point is, we've been on this journey for quite some time. Ironically, before brokerage-based trading in equities got really complex, sort of post-World War II, we were actually settling T+1 in the 1920s, right before the Great Depression. So this concept of settlement and settlement dates has actually been something that's been around for quite some time, almost for the history of Wall Street here, but definitely a lot of compression and acceleration in the, let's call it, the past 50 years. Now, I do want to do a little bit of a quick show of hands before we jump into the rest of the panelists' discussion here. A quick show of hands, how many agree today is November 19th? Right, and it's sort of it's a trick question because everybody should agree. Now, yeah, it's about 50%. It does highlight
everybody else
maybe a bigger problem there. Now, if I asked you to tell me what time it was, and I asked you, is it 3:58 p.m.? You could raise your hand if your watch says 3:58 p.m. But the point is that there's actually less people who can actually agree on time inside the day. So some people might have a clock that says 3:58, 3:50. Some people have 3:57. Some people have 3:59. Whereas everybody agrees on November 19th, right? And the point is that there's a big leap to get from T+1, where you have a nice, clear, agreeable end of day boundary, to the point where you're actually doing things inside the day, right? And that's the crux of this panel discussion. We could probably spend an entire day talking about it, at least based on our prep call. But I'll stop the history lesson here so we can talk about what lies ahead, what is going on that you should all be aware of to really embrace and maybe take back, or have a deeper dive discussion with us after the panel. So hopefully that was helpful, Reza.
That was very helpful, and thank you for the little games. I did my homework too, and I didn't have any cool dates, that popped up. But in terms of how successful this transition was, the metrics actually did surprise me. Okay, so as of the end of September, DTC affirmation rates were in the mid-90s, which was above the recommended 90 rate, and then higher than 73% in January. Everyone in this room knows that that doesn't just happen, right? So let's just now uncover the work that had to be done for that transition to be possible. Like, what are some of the catalysts, what are some of the technologies that have enabled us to be where we are today?
I can start if you want. I mean, we were talking about this before. I think the reason that T1 went so smoothly was because we actually did all the heavy lift to go from T3 to T2. And I remember when we did that on our technology stack back in 2017, I didn't realize it was 1993 that it was T+3, but it was pretty much hard coded. And so we had a brand new technology stack. As I said, when we built the company in 2012, we were cloud-based right from the beginning. And so we had made the investment in making that configurable and changing the systems to support T+2, which was a little more challenging back then. So I think we were in a much, much better position today. And certainly the technology has changed since 2017. I mean, we're completely cloud-based. The technologies that are available to us, even, we're in Amazon today, are much more advanced than they were in 2017. And I think from a scaling perspective and the ability, as an example, to have all of our ID confirms set before 8:30 in the evening when you finish trading at 8 p.m. because we go extended hours, so that you have everything ready for DTC at 9 o'clock. The technology, I think, to speed that up and have the efficiency to have all that complete in a short period of time was key. I think the other thing is, again, we've done a lot of really innovative things with our tech stack. We have an API that basically tells our clients exactly how much they need to settle with us, and we give that to them at 8 p.m. Many of them can integrate with that, and they can automate the process to actually then wire their funds to us next day. So again, I just think having done all the heavy lift back in 2017 well prepared us to go to T+1. And then again, just the emerging technologies and the way we built our tech stack, it kind of made it quite seamless. And actually it did go very, very, very seamless for us. To John's point, I don't think it's as simple to go to T0, right? To go to real time, there is a lot of things that come into play. I mean, even just the most basics of if you're working with a foreign client and their wallet is in a foreign exchange, in a foreign currency, there's translation that has to happen before they can settle in US dollars, right? There are trade errors that occur that you need to handle before you actually settle, right? So I think there's a lot to have happen. I think the technology is making it easier for sure, and at some point we will get there, but the entire sort of ecosystem has to be aligned with that, right? Even other markets have to be aligned to do that.
So I'd like to take a shot at that. Definitely agree with what's been said so far. The reason why we were able to go to T1 is because of all the mindset thinking. But just to not go back in history a long time, the T5 was not the longest. In Europe, in the UK, for example, there were 26 settlement periods a year, every 2 weeks. So settlement A started first 2 weeks in January, settlement B was the next 2 weeks in January, and so on and so forth. And we have T5 and we have T3. What it really came down to it is that people needed time to reconcile these systems. Before my time, I'm old, but not that old, but the exchange used to close on Wednesdays so that people would have time to settle. So the work that's being described here to bring in a real term, so what's happening is there's all of these systems. The front ends may be on real time, but there were batch jobs and processes that had to happen, and they had to occur overnight and over multiple nights, right? When the towers came down, everybody at Fidelity was telling me, oh, we're not going to run a batch cycle tomorrow, right? I said, oh, yes, we are. And why? Well, because I got money sitting out there that hasn't settled yet. And every day we had that question. And so the real change to go to T1 is that all of these processes that were being fed, I don't even know in terms of question, do people here know what a batch job is, right? It's basically a job that you submit in the background and the computer works on it. That's really what has had to have changed. So going from T3 to 2 and now to 1, it was easier because we started thinking differently. So that's the behind the scene, why it used to take so long. I would like to take a different viewpoint on going forward. The timing is difficult, but the exchanges, not now, 10 years ago, implemented clock synchronization. So everybody that wants to trade with the New York Stock Exchange and with any other exchange, you have to have your machine synchronized. When you stamp a trade as A5213, we all have to have those things synchronized. I think the real obstacle now is less about technology and it's more about the support system. How do we get that money across real time, right? The trade-off of money taking a day or two to get to you and getting it real, it's not trivial. Anybody looking at the headlines, you see there's a number of fraud, right? There's a very large bank that had an issue where people were lining up to fraudulently do something with checks. So even today, so I would argue that yes, it's not going to happen tomorrow. I think we figured it out. Like for T1, my group participated in the test, but we had to make no changes because we have started to write our systems for instant settlement. So instead of having batch in our system, we do it real time. When you open a trade now, I compute the TLA, the tax lot accounting, so that you decide to. I do all that real time, and I just wait for the rest of the world to catch up to me. And I'm sure I'm not the only one. I'm sure there are other people doing that. I think the real problem is going to be instant settlement of money, and that is a whole different conversation. And you could see that can it be done? Yes, but the fraud factor goes way to the roof. I think that's the obstacle.
Yeah, if I could continue the thread, right? So I agree with everything you say, and I want to emphasize that point, right? So going from T3 to T+1, yes, we had learned a lot from T3 when we went from T3 to T+1, but really going to continuous, the next piece, that's a different ball game, because fundamentally all the systems have been designed to be batch oriented. What does that mean? That means the systems have a concept of a chunk of data and a point in time where I take a snapshot of the chunk of data and I hand it over to the next system to do its thing. Now, as you're shrinking this window, you can keep shrinking it, and you can do more intraday transfers, and you can do more real-time stuff. But at the end of the day, fundamental architectures are still snapshots, move the data. Snapshots, move the data. But what I wanted to highlight is that there are some fundamental technical changes that are happening which are going to change that, I believe, for the better. So one of them is that a lot of systems are moving away from transferring files for transferring information to things like event-based streaming. So we, for example, made a conscious decision some time ago to start implementing corporate-wide, streaming mechanisms with event-based. So what does that mean? What that means is that when an event occurs, a trigger then sends some sort of data stream to the next system to be able to react to it, rather than waiting for a certain point in time. It's more of an event-based triggering system. That's one thing that's happening, that's going to change. But the real big thing is, as we are going more into a distributed ledger type of technology with the markets which are continuous, those systems already have the ability to have information transmitted across the different participants at real time. The challenge is this has to work with your traditional batch-oriented systems, because you're not going to have a DLT-based system sit in isolation. Most of the assets in the world, 200 trillion of them, are in your traditional systems. You have to find a way to make them work together. And we have invested in a platform, and where we have put connectors in place so that you translate these events as much as possible using technologies like event-based streaming and other things. So I'll pause there because there's
lots to
No,
talk about.
Great.
there, but-
We already moved into the
Yeah.
forward part of the discussion, which is great. Last week when we spoke, we talked about this concept of retailification of finance, right? Of everything becoming more user-friendly, of expectations being that everything is instantaneous. Can institutions keep up with this trend of retailification?
I think so. I don't think it's something that people want to do because it's going to cost a lot of money, and there are going to be people that say, well, the system works fine the way it works now. Why do we need it? I think what's raising the bar is that even if you think of the federal banking system as probably the most conservative thing in the world. Well, last year, or was it the year before? Last year they announced not one, but 2 real-time payments. So they went on May and said, Fed now, it's instant. And then a month or 2 later, real-time payment, RTP is ready. I think what that recognizes is what we all know, right? You have people come to your house, you pay them with Venmo, you use Zelle, you what? So the need is there. In countries that are less developed, it's actually happening. Like that's the only way people transfer money, right? People have never been inside of a bank. If you walk the Great Wall of China, they have QR codes that you scan for that bottle of water that you need. So the reality of it is that in some way it's already been sold and adopted by the masses. But we now got to figure out, and again I go back to the point, is the obstacles in my head, we have learned how to go around them. So what does that mean? Well, we got to start writing message real time.
Right.
We have to use event-driven instead of waiting for a batch cycle to say, well, at 7 o'clock, I'll start running. All of that stuff we learn. What it really comes down to it is how can I validate that this transaction is real? Because once that money is gone, it's gone. And that's where I think you've seen things like cryptocurrency and all this other stuff. Well, guess what? Even cryptocurrency is not instant. You may see the stuff in the chain, but try to go buy it. You may see delays arranged for 30. So what it really comes down to is a series of regulations and a series of mindset changes that are going to be the ones that take it there. I personally think it's going to happen, and we might as well embrace it. But I also think it's going to make us think outside of the box, and there's still many patents that will be written on this.
I would argue that actually our company is already there. And I'll give you guys some examples. So first off, our communication between our partner, the introducing broker, the RIA, and us is all through a REST API within an associated real-time streaming event. So we use Amazon's SQS events, and for every API request that you make of DriveWealth, you get a real-time update. So once you actually create the user and create the account, everything that occurs, right down to a corporate action on the account, status change on the account in order, you now get an event that you just listen for and update your data store. So we're already kind of at a real-time interaction with our clients. The cash available for trading, the cash available for withdrawal, the positions, how much is available to trade, everything is in real time and is updated in each and every event that goes back to the client. Now, on the other side, on the back end, right, there are still batch processes, right? There are still files that are created, right, with DTC or with other custodians and so forth that, will need to be enhanced. But I think what we've been able to do with our technology is actually create that instantaneous interaction between a brokerage account and a wallet. So one of the things that we created is something called cashless brokerage. There's never any money in the brokerage account because all the money resides in our partner's digital wallet. They are the account of record, okay? And the experience that they wanted to create, the Cash Apps of the world, the Revoluts of the world, the Tosses of the world, is they wanted the experience of, buying a cup of coffee with your debit card or your phone right out of that digital wallet to be exactly the same experience as buying $5 of Starbucks stock or $5 of Apple. And so our technology actually enables them to directly have the money come out of the wallet when they purchase securities. And more interestingly, when you sell securities, the money in real time flows directly back into the wallet. Now, under the covers, we settle T+1. So from a regulatory perspective, it's all fully regulatory compliant. We're not sending any money back before it has settled. But the partner, being a payments company, can provide effectively an interest-free, unencumbered loan to the client, no different than advancing a deposit of your, check, your paycheck 2 days ahead. And then we settle with them the next day, and they take that little short-term risk to create this incredible embedded experience. And so what happens is the technology enables what was once a very bifurcated experience, right? Here's brokerage in this app, and here's banking in this app or digital wallet. I have to onboard over here, and then I have to send money over there, and that takes a day or two, and then to get the money back takes a day or two. Where we are now is the onboarding is instantaneous, and then the transaction comes instantaneously after that. So I can go from not having a brokerage account to instantly owning stock in seconds. Now, with the evolution of 24-hour trading, imagine a world in which it's 2 o'clock in the morning and, I need access to $100 that's invested in Apple. I could sell that stock overnight in the overnight session and have instantly access to that $100 to spend on the debit card, right? All being done in a compliant way. So the back end, yes, still has some batch processes to make the settlement work, but at the front end, we actually are now literally simulating a real-time interaction between investing and the digital wallet.
And I think
Most of us there. What I'm saying is to complete the cycle, banking also needs to be there.
Oh, no, 100%, right?
Because otherwise you can provide a buffer of money, but up to a certain point.
And that's this is very important, for you all to take away. The experiences, the real-time experience you might have just transferring cash, right? Now, on a retail basis, we're all retail investors here. So the amount of cash that we're ever moving with a fintech app is going to be relative. There's going to be some boundaries around that. Retailification of the trading experience is such that we by moving cash in real time, in my case, probably some of my kids are moving cash in real time all the time. Their expectation of trading is that it's real time and it's 24/7. So they're going to demand it. They're going to demand a real-time user experience. Now, even if settlement doesn't happen right away, you might have real-time settlement for cash. You might have real-time payments settlements on the RTP or the FedNow rails. But when settling the actual regulated securities, equities transaction might not be in real time. But I think the retailification user experience is the real sort of key message here, is that is an expectation. Either it's already in market or it's an expectation, and folks are building to that already. The other point I wanted to make is that there is when you start to think about retailification, it is a bigger journey for institutions to get there, right? And I'm going to throw out some big numbers like, let's say call it $2 trillion or so, give or take, probably a couple $100 billion. I never really normally get to say that, but I'm saying it here. But $2 trillion of settlement a day, right? That's sort of, just think about the U.S. securities industry settlement happening daily. That's a big number. So obviously there's a lot of risk if you get any of that settlement wrong. Retail is let's call it 20% of that number as well, right? So it's not as big of a risk in retail, but that's where the innovative trading real-time experiences are going to come, and expectations, which is really cool. But I think to George's point is that you're trading an asset in return for cash. So you can't just look at the asset in isolation. You have to look at the end-to-end flow of what's real-time from a end-user trader perspective, and then what ends up happening behind the scenes. And that's where a lot of the exciting innovation and technology comes, to actually make that stuff that happens behind the scenes happen faster, right? Not just T+5 or T+3 or T+2 or T+1, but actually, starts to do things in more of a real-time basis, so that, when the entire environment of, I think there are about 600,000 registered FINRA reps around the United States just working in the securities industry. There's a lot of people that need to conform to a faster settlement cycle. So that's going to take some time and effort. But I would argue, based on what we heard today, that a lot of the tech is already there. It's waiting for everything else to catch up.
So just last question, before we wrap up. Is there a big tipping point coming up, or is it just a lot of small tipping points? Like, what are we, in the context of continuous markets, what are we going to be talking about next, Benzinga?
I think the tipping point is that all the stuff that we hear in different ends of the world, emerging technology, it's gonna start making an impact. We've always, for example, done back testing for trading. That's the notion. If I bought it a year ago, what would it have made? Well, with AI, right, and there's a lot of hype, so much hype about AI, but there's some real capability. It is so easy now to apply AI to a world where you could make that calculation and with a much better precision. I think that's going to start showing up initially in back office to help things happen. We're going to be a little bit more judicious about bringing it into the public because we have to. What you guys are missing is all of us sitting here, we're burdened by tons and tons of regulations, right? There's regulations that have been written over the 50 years. We're still calculating SEC fees, even though we may not use them, and so on and so forth. So is it going to happen? Absolutely. I think you're going to get emerging tech, meaning even people are going to want to trade. We foresee a day where people use Discord to check their balances. So we have a bot today that does that, right? And this is all experimental. Remember, I'm speaking on behalf of the Center for Applied Technology. I don't want people to say, hey, Fidelity said you could do this. But we are already there, and we are already doing virtual stuff. And so the answer is yes. I think it's gonna get even better than what it is now. But have a little patience because at the end of the day, we got to settle all of this, and fraud is everywhere.
So we are out of time. So I just want to make one point, okay, to what you were saying. The front end being real time, but in the entire cycle, there are pieces that are not. So there is someone's carrying that risk, and that has a cost. So unless that thing can be optimized, you're not going to get that benefit to the end user. So we got to look at the entire ecosystem. And the tipping point is probably regulations in my head.
Thank you, everyone. Thank you, gentlemen.